Hello and welcome to Cafe Mutual YouTube channel. Friends, over the last 1 year, equity funds have delivered not so good returns. In fact, the market remained flat despite events of volatility. In such a scenario, does it make sense for you to continue to recommend equity funds? To answer this pertinent question, today we have with us Meenakshi Dawar, Fund Manager, Nippon India Mutual Fund. Meenakshi has over 13 years of experience in fund management and equity research. So without wasting time, let's welcome Meenakshi Dawar. Good evening, Meenakshi.
Good evening, Nishant. Thank you very much for having me on your channel.
Yeah. So Meenakshi, my first question to you is that over the last 1 year, equity markets have delivered returns which are less than inflation. Okay, and there were many causes of volatility. So given this background, why do you think that MFDs should continue to recommend lump sum investment in equity funds?
We all know that equity is a asset class which is a volatile asset class, and if you just go by history of equity as a return generator for the investor, this has always beaten inflation returns much higher than other asset classes. Now, there are certain times where equity becomes more attractive compared to other asset classes. And fortunately or unfortunately, that time always comes at a junction where there is a lot of uncertainty and market is not sure about what the future growth rate will be. And that's how the valuations becomes attractive, and that's the time when you make return which is better than the CAGR return of the market. And I think we are at that time where there is a lot of uncertainty in the market, right? And if you see over last 1.5 years, that has been rightly reflected in the returns that have been generated in equities. Like you said, there have been no returns that have been generated for the investors. And if you see like near-term data points, which is very important for us to monitor as of now, it has been of investor being not confident about future growth rate. Till now, the equity was not generating as much return because interest rates were going up, your cost of capital was going up, and there was readjustment that was happening in the valuation multiples. And now we are at a point where market is not sure about what that cost of capital is, and on top of it there are a lot of these events that has happened in the market, right, of some of these US banks coming under stress coming in financials in Europe, all across, which is leading to growth uncertainty. And I think for a investor, this is a very, very good time to build portfolios, because right now is the time when you will get the assets or the companies that you want at a price that you would ideally want them to invest in. And if you remain invested in a period where this uncertain time will get over, which will get over in next 2 to 3 years, where market will again become normalized market, you will make return which is maybe better than what the historical CAGR return rate for this asset class.
So this takes me to the second question, which is your medium-term outlook on equity markets, and what are the key risks for market from here on?
Correct. So, see, India remains a growth market from a medium term perspective. So, we have a lot of levers for growth. So, consumption remains a basic growth driver for us, which is a CAGR story. On top of it, we have entered a cycle where the capex is also looking well. So, you look at capex from all sides, like government capex, private capex, that is all trending up well, and the health of the economy is pretty good. So if you look at banking, which is the funder of growth, so their balance sheet is in far better shape than what it was in the earlier cycle. And if you compare it with the global uncertainty and outlook of global growth, we look far better than what in from a global context point of view. So we are very, very positive on the medium to long term growth outlook for the for India. Now coming to your second question is
Yes. Okay,
yeah,
so
sorry, can
what
you
are the key risks for the markets from here on?
right. So, key risk for Indian market is same as maybe what it is for the global markets as we stand today. Now, the trend of few things, right? Interest rates going up so sharply in such a small period of time, that with itself brings a lot of risk in the market, which is very difficult to predict as we stand today, and it only comes as a surprise or as a shock to all the investors. So this risk remain for our economy as well, that interest rates have come up, although it is not because of what has happened domestically, it has happened more what is happening globally. So our rate cycle is a response to what the rate cycle globally is. So when interest rate goes up so sharply in such a small period of time, there will be consequences of that. So first consequence is that any over leveraged institute comes under far higher scrutiny. There can be risk emerging from those institutes. Or second can be the impact on growth, right? When the interest rates go up, you have tighter liquidity in the system, which the second derivative impact of that is growth, which we are seeing in some pockets in India as well, where the growth after such a strong run of 2021 and 22, we are seeing that in 23 some pockets of Indian economy is decelerating and the growth is slowing down.
So, Meenakshi, talking about Flexi Cap fund category, so this category commands the highest share of assets across all equity fund categories. So, what are the three key reasons for this popularity of Flexi Cap funds?
See, FlexiCap is a very good category for the investor who does not want to take those calls of whether I should invest in large cap, whether I should invest in mid cap, small cap, which pocket are we seeing return possibility of higher return. So a lot of times those decisions are best left to the fund managers. And in this category, because there is a flexibility that you can move across market caps and you can adjust your portfolio depending upon where you are seeing value emerging, this makes a very good category for the core allocation for any investor. And any investor who is been in the market, understands market cycle, they can always top it up with mid cap, small cap funds. But this category, because it has a characteristics of being core to the investment universe, it is a large category for the investor.
Okay. So, but Meenakshi, Flexi Cap funds are more or less similar to multi cap funds and ELSs. So, what additional benefits can investors get by investing in Flexi Cap funds that are not possible through multi cap or ELSs?
Yeah, that's a very fair question because it's been recently that we have had two categories, multi-cap and flexi-cap. Earlier, it used to be classified only as one category. Now, what happens is in multi-cap category, there is still anchoring in terms of how much you will allocate to each market cap bucket. So, a multi-cap will at any point of time have to be at least 25% invested in small cap, mid caps, and large caps, right? So, even if your view on small caps is not very good at any point of time, the fund has to be invested in that particular segment. Whereas in FlexiCap, that choice is being completely left to the fund managers. So you can see FlexiCaps funds in this category who will be operating at maybe 70-80% large cap. You can have funds which can operate to as low as 20%, 30% in the large cap. So in terms of flexibility, this has the highest amount of flexibility that and choice which is being left to the fund manager depending upon where they see the market trends and market opportunities are. And ELSS is more of a solution oriented category, and there also it depends on how the fund managers have taken that choice where they want to be placed in it. But more often than not, that category has always been large cap bias in nature. So the allocation to large caps have traditionally been larger than you will see in a flexi cap fund.
Okay. So, Meenakshi, Nippon India Flexi Cap Fund is a new entrant in the Flexi Cap space. The fund has a track record of over 1 year and it has performed in line with the benchmark. So, what strategies have you deployed to generate alpha over the next 3 to 5 year period?
Correct. So, we have taken complete advantage of that flexibility that has been given to a flexi cap fund in terms of allocating capital to large caps, mid caps, and small cap bucket. So we are true to label flexi cap fund where we have decent amount of allocations to mid caps and small caps stocks. So the way this fund is being constructed is that there is one set of companies which are getting reflected through large cap allocation, which are stable companies, which are market leaders in their respective segment, and you can generate CAGR returns from them. So they provide a lot of stability to your fund. But in India remains a growth market, right? So we have a lot of sectors which are emerging sectors, which are mid cap or small cap in nature because the opportunity today is small. But as the market develop, as these sectors develop, these sectors or these companies can participate in large profit pool opportunities. And there are some companies which can grow faster than the sector growth rate. So all these, companies which are very bottom up in nature, which can definitely grow faster than the market growth rate over a long period of time. So all those allocations are being done by these small caps and mid cap allocations in this fund.
So, Meenakshi, we have observed that unlike other flexi cap funds, which are, as you have mentioned, that they have large cap bias, Nippon India
Correct.
Flexi Cap Fund has close to 35% exposure to mid and small cap companies. So, what's the reason for this?
So, in India, if you want to generate return which is better than the index return over a medium to long term perspective, you have to participate in these growth sector, like I mentioned, or growth companies and companies which are smaller in size currently, and the size is therefore in their favor. Or there are these new emerging sectors which are coming in India, which are they are there because there have been recent listing, or there is an economic curve, right? Country curve. So a lot of companies like retail, right? To give you an example, a lot of these companies which are listed in India are mid cap and small cap because currently the profit pool that they've been chasing is smaller in size. But as the market grows, if you see the trends in the developed market, these will definitely be a large profit generator for us.
So, Meenakshi, the fund is well diversified across 16 sectors. However, in absolute
Correct.
terms, the top three sectors are finance, technology, and services industry, which are account for more than close to 50% of the total portfolio size. So, why are you so bullish
Correct.
on these three sectors?
See, banking is a large sector for us. In our benchmark, also, the composition or the weightage of this sector is fairly large. And this sector currently is at a point where a lot of things are going right for the sector. So if you look at from profitability point of view, it is in a phase where credit growth has been good and margin delivery has been good for the sector. The second thing is that the asset quality pains, which we see in this sector across cycles, we are at a point which is one of the lowest. So if you look at the credit cost, it is below what has been the average across cycles. And if the third thing is the valuation, which is a very important thing. So in spite of the sector doing so well after COVID, it is not that the valuations have run up ahead of the earning delivery. So valuations are still at decadal average multiples. So this sector can give you, we believe, can give you a return which can be better than the market return. And because in this is sector is very domestic looking sector, and in this uncertain global uncertain times, it also gives you protection, and also you can continue to participate in that domestic growth story through this sector. And the second sector you mentioned was technology, right? This sector, after a very good run post COVID, corrected also, right? The valuations of the whole sector corrected, where it underperformed the broader market. Now, the whole reason for that underperformance was because everybody is talking about growth deceleration in the developed market, and therefore growth being lower for the IT company, where a lot of revenue gets generated from what is happening to the global IT budgets. Now, lot of these uncertainty is already in the price for a lot of these companies. So if you look at from a long term perspective, these companies are growth companies. In very, very uncertain times also, these companies have continued to grow. And the second thing which has come in favor is that the margin pressures that these companies had, because employee costs were shooting up. A lot of companies were building bench strength. There was heightened amount of churn rate in the employee. All that pressure, supply side pressures, have clearly eased off. So now for these companies to replace talent, which maybe a year back was to now is 30% lower. So, in terms of their ability to deal with the slowdown in revenue by using these margin levers, which always exist with them in terms of on-site, off-site mix, in terms of pyramid correction, and those all exist. So their profit growth can be little higher than what their revenue growth rate is, and valuations are reasonably pricing in the deceleration. So we have reasonable allocation in technology as well.
So, Meenakshi, one final question. What makes Nippon India Flexi Cap Fund unique?
So, like I said in the big, like you pointed out, that there are a lot of funds in this category which are large cap biased still. But because we have taken that call that we are going to actively look at generating returns from mid caps and small caps, our positioning is such that we have a good mix and a balanced mix of large caps and mid caps and small caps in our portfolio. And in terms of our positioning, in terms of our ability to pick up that bottom up ideas in mid caps and small cap exists because the size of the fund is also in our favor. So a lot of these unique companies, a lot of these differentiated companies are there in the portfolio, which we believe can deliver a return which is better than the market return over a medium to long term.
Great. With that, we have come to an end to this interesting session. Thank you so much, Meenakshi, for your valuable time and insights.
Yeah. Thank you very much, Nishant. Pleasure was all mine. Thank you very much.
And finally, I thank each one of you for being such a wonderful audience. Have a great day, guys.